Hello, this is Ben Socek with StealthHomeBuyingSecrets.com, and today we have a special guest, Ryan Larsen, with Regent Financial Group, and he is going to discuss a few mortgage myths that he sees in the market. And Ryan, thank you for joining me here today. If you would just kind of introduce yourself and what you've done in the mortgage industry there in Omaha, and then we'll go through some of the mortgage myths that you see in the market.
Absolutely. Thanks for the introduction, Ben. I'm Ryan Larsen with Regent Financial Group. I've been in the mortgage and lending arena since May of 2002. So going on 18 years of being in the industry.
So you've seen a thing or two as well then?
Absolutely. Yeah, the highs and the lows.
Very good. Well, with that, let's just get into your PowerPoint, and we will go to the first item on here that in regards to the required down payment that
Correct. Yeah. One of the biggest myths I see in this market still is it's still the old school thinking that you have to have 20% down to buy a home. That's obviously not the case. Clearly, the more money you put down, the lower your payment's going to be. So having a bigger down payment is beneficial, but it's not a necessity or a requirement. Below are some loan programs that we offer that do offer lower down payment requirements. First, there's VA financing, which you can finance 100% of the purchase price, and no down payments required with that. Same with USDA. It's a no money down loan program designed for rural areas outside of the Omaha area. Then you have your traditional conventional loan. You can get in with those with just 3% down for a down payment. So those are very affordable. Next is the FHA, the Federal Housing Administration backed loan. The minimum down payment of that is 3.5%. And then we also do offer the NIFA, or Nebraska Investment Finance Authority loan programs, which partner up with conventional and FHA financing. And the minimum down payments with those is just $1,000 out of your pocket.
Very good. And obviously, and the same goes, or will be applicable to all these that we'll discuss today, but we're recording this in March of 2020. And so I'm sure, like you've seen, programs change in time, but what we're discussing today is what's applicable today.
Correct.
So, and moving on to credit quality of the borrower.
Yeah, another common myth I run into is a misconception that you have to have perfect or excellent credit to purchase a home. This simply is not the case anymore. We can do loans with a credit score down to a 580. There's a minimum credit score that we require. Ideally, to make things as smooth and seamless as possible, primary goal is to probably have at least a 640, but we can secure financing with scores as low as a 580. There's other requirements that do apply, but if you have a minimum 580 and some compensating factors, chances are we could probably get you approved for home financing. Missed payments are okay. If you have missed car payments or student loan payments or credit cards, those things like that do lower your credit score, but it's not going to keep you from buying a home. If you have too many of them, yes, it will impact your score, maybe make things more challenging, but just simply having a few late payments, it's not going to get you into any trouble as far as securing a home loan. Also, collections can remain open. We don't require that the collections be paid off. So depending on the collection amount and your income, you can still qualify even if you have open collections. Also, tax liens do not have to be paid off. We just simply have to show that you are in repayment and been making the payments regarding any like past due federal income taxes.
Okay, so that's a lot of flexibility on those issues then.
Definitely.
And on, if I can get my mouse working here, discussing bankruptcy, that's of course a big item from the past.
Yep, that's correct. Yeah, a lot of times I hear clients that they've always been told, they were told by somebody at one time that their bankruptcy had to be discharged or will be 10 years out. Another common number I hear thrown out there is 7 years, that you have to be outside of the bankruptcy for 7 years, which is not the case at all. So their FHA is very flexible on past bankruptcy matters. There's two different types of bankruptcies that you'll see commonly with individuals. One's a Chapter 7. which simply just discharges all of your debts. There's no repayment expected on those. And then you have the Chapter 13 bankruptcy, where the trustee, along with your attorney, will set up a repayment plan. Typically, the repayment plan is going to be up for a 5-year repayment plan. So with the Chapter 7, in order to be qualified to purchase a home, at least 2 years has to have lapsed from the time that your bankruptcy is discharged. Not the date that it's filed, but the time from when it's discharged. The Chapter 13 does not need to be discharged in order to qualify for a mortgage. We just simply have to document that you've been in repayment and having a satisfactory payment history with the trustee for a minimum of 1 year. So 12 months of on-time payments and a Chapter 13, and you'll meet the minimum requirements set on bankruptcy seasoning with FHA financing. VA actually provides more flexibility than FHA. It does allow for a person to qualify for a VA loan with a Chapter 7 bankruptcy after the discharge date of just 1 year ago. So with VA, you can purchase a home if you've had a bankruptcy discharge at least 12 months or more. And then with the Chapter 13 with VA, you just simply have to be in repayment for at least 1 year with on-time satisfactory payments. And then conventional on a bankruptcy, it's 4 years from the discharge of a Chapter 7 and 2 years from the discharge of a Chapter 12 or 13. So as you can see, the Chapter 7s and 13s are not going to put off home buying for 7 or 10 years. It's complete myth. As you can see, you can get into a home typically just after 2 years of one of those negative events happening or occurring to you.
Okay. So especially if you have that VA eligibility, either are in the military or have been, certainly gives you some flexibility there as well to work with. And if a person has had a foreclosure in the past, obviously there's some flexibility with that as well.
Absolutely. So yeah, the foreclosure dates vary depending on which program you go with. But for example, FHA is just 3 years out from the completion of the foreclosure. So a lot of times similar to the bankruptcy situation, folks will think that their bankruptcy or their foreclosure has to be out 10 plus years or 7 years, and it's not the case. FHA is at 3 years. VA requires it to be 2 years out. And for example, even if a veteran had a past VA loan that resulted in foreclosure, they are still eligible to use a VA financing for the next home purchase. The amount that you'll qualify for is going to be based upon the amount of entitlement that's available. If you had a past VA foreclosure, the next VA loan would have to be purchase price and loan would have to exceed $144,000 in order to run into where you'd be using your bonus entitlement, and that can be used to provide the entitlement that you need for your next VA loan. So you can have past VA foreclosures and still get another VA loan. And then finally, conventional, they're a little bit more strict on that, but they just require the 7 years. So even if you've had a foreclosure in the last 7 years, you just have to wait till you pass that 7-year mark on conventional in order to buy. So even if you don't fit into a conventional loan, usually someone could probably take advantage of FHA financing and still secure a home loan without having to wait the full 7 years.
Okay. And Ryan, is there any difference if a person has medical issues that may have caused some of those challenges in the past with their credit, or does that make any difference when it comes to a bankruptcy or some of the other issues that we've talked about?
Correct. Yeah, we can make exceptions to those hard foreclosure and bankruptcy rules in cases of medical reasons. We just have to thoroughly document and show everything that was negative on the credit was tied to a medical condition, was tied to a major illness that kept the person from working. That's the main things are looking for exceptions on there, or if it's a downturn in the economy and unemployment's at all-time highs, they'll make exceptions for that. But if it's a matter of maybe a divorce situation, they're not going to make exceptions for that. So for medical, employment losses, things like that, hardships that are out of a person's control, they can make exceptions to those rules.
Okay, very good. And of course, pre-approval. I'm sure some people are hesitant to start the procedure just because of the unknowns, but let's talk a little bit about the pre-approval process with you.
Absolutely. So the pre-approval process is very simple. At this point, we just kind of interview the home buyer, trying to find out what their goals are, what they're trying to purchase, what price range they want to be in, what type of payment they're comfortable with, kind of fill them out, get their level of comfort as well. But in addition to that, we're going to ask a little more detailed things, your address history, your employment history for the last 2 years, and also what your income is. We need to know if you're paid hourly, how much you get paid per hour, how many hours a week you work, if you're on a salary, what is that? We're also going to ask information regarding assets, because we have to document if you have a down payment involved in your home purchase. We have to document and show that the person has the ability to put the money down. So as far as the application process itself, typically most of it's done either over the phone or online. The process is very simple. The questions we ask, the application that we have online to complete, should not take anyone more than 10 minutes to complete the application. Once the application is complete, we typically will have an answer back to the home buyer within an hour. Usually it's within 20 or 30 minutes after speaking with them on the phone. It's very simple. It's just basic questions that anyone should be able to answer. And then as far as documentation that's needed, most of the documentation is really simple and things that clients can get their hands on rather quickly. Examples of that, if you have a W-2 employee borrower, that is W-2 meaning you work for somebody, they withhold your taxes and insurance on your pay stubs. We would need 2 recent pay stubs. We would also need your W-2s for the last 2 years. So if we're talking this year in 2020, we'd want to see the 2019 and 2018 W-2s, your driver's license, and then 2 most recent bank statements. This is kind of what's needed to verify and document the assets needed. For individuals that are self-employed, typically what is needed is just the last 2 years of your 1040s or your last 2 years income taxes. We're not concerned about what shows up on the state return. We just simply look at what's on your federal return.
And obviously there's a difference between kind of the phone approval process and getting those required documentation so that you have them in your file, so that it is what I would consider a real pre-approval that buyer can take out to show potential sellers that they really are qualified, not just that it's a verbal pre-approval. Would that be accurate, or can you speak a little bit?
Yeah, correct. Yes. Common terminology you'll hear in the mortgage and real estate is pre-qualified and pre-approval. So when an individual is pre-qualified, they've simply submitted their application online, submitted it in person or over the phone. Pre-qualifying meaning I did run their credit, but as far as their income and their assets, I'm taking it from as their word, what they have provided me. So at that point, it's a pre-qualification. When it turns into an actual pre-approval is when the applicant provides me the necessary documentation for me to review their pay stubs and say, yes, the income you provided on your application is true and accurate. Once you provide it all with the documentation, the pay stubs, the W-2s, tax returns if necessary, your driver's license, and the bank statements. Once we have all those, you're pre-approved. So pre-qualifying is just verbal, what the client tells or provides on the application. The pre-approval is just taking it a step further and verifying that information that they supplied us. So pre-qualification is only as good as the information that we're supplied with. So it's important to get pre-approved, provide your loan officer with the income and asset documents that are needed so they can make a good lending decision on your application.
Okay, thank you for that clarification, because I think I know in my past anyway, there's some miscommunication or misperception of how qualified that buyer really is when they're looking for a home. So that's very important there. The other question that I have, I guess, is once that pre-approval, that hard pre-approval is done and you have all the documentation, does that last a certain length of time before you have to do another application or have the buyer rerun things again? Is there a time frame in there so that the home buyer isn't feeling pressured that they have to do something, say in 30 days or something like that?
Correct. Yeah, that's an excellent question, Ben. So when we pre-approve somebody, their pre-approval is good for 120 days, meaning they have to go under contract and close within 120 days. If a client submits their application, they take a while to find their home, they don't close within 120 days, then at that point, we just have to update their application, obtain a new credit report, re-verify the information they supplied, gather updated pay stubs, financials, bank statements, kind of start the process over again. But since we have all their information already, to update it is usually very streamlined. So it's good for 120 days. Key thing is it has to go under contract and close within 120 days. If you go under a contract and it closes on day 121, we're going to need a new credit report. So the key thing is to close, take possession within 120 days of that credit report, and then we will have to run that credit report that one time. So.
Mm-hmm. And at the same time, it doesn't sound like it's terribly difficult if it's past that 120 days, just to verify that really nothing has changed and that they are still in the same position that they were before that, so that they can stay qualified, so to speak.
Yeah, that's correct. It's a very simple process. It's just a simple matter of just kind of updating things, making sure everything's kind of maintained on their credit report. In 120 days, there might be a need to take out additional loans or buy a new car, different things like that can affect your approval amount. So that's why after 120 days, we have to update that information. But as long as an individual just kind of remains everything the same on their credit, doesn't take on any additional debts, usually nothing changes too much within that 120 days. So as long as they stay on top of all their finances, maintain a good payment history on things, updating and requalifying is very simple and streamlined.
Very good. Anything else that you want to discuss that you think is important in regards to the myths or just getting a person pre-qualified if they are interested in starting the process?
Yes, I encourage everyone to start the home loan process months before you begin looking for homes. If you know you're going to be looking at homes in the next few months, you need to start the pre-qualifying pre-approval process now for a mortgage. The reason I stress that and say that is there's sometimes things on the credit report that's going to keep you from buying a home. So the earlier we can find out about it, the earlier we can address it, the earlier we can fix it and get it ready for you to buy a home. So if it's this fall when you're ready to buy a home, it's probably a good time to start having your loan officer review your credit, give you an idea of what you can afford. That way you're not going out looking at homes that either aren't in your price range or more than what you can afford. It's good when you're buying a home, you need to be informed and know what your options are. So if you're just going out and buying a home before you're pre-approved, you're kind of doing things backwards. You need to find out financially what you can afford and what you qualify for. So that way you're using your time wisely. You're not wasting time on things that may or may not work out for you.
Very good. Ryan, would you like to tell people if they're watching this or hearing this, how they can get in contact with you and the best way to do that?
Yeah, absolutely. Best way to get a hold of me generally is going to be my cell phone, which that number I can be called or texted anytime, any day. My phone number is 402-871-2985. Again, 402-871-2985. Either call or text me. Otherwise, you can always reach out to me via email. My email address is ryan@regentfinancial.com. So email and cell phone is usually the best way to get in contact with me, and I look forward to hearing from you.
Very good. Well, thank you, Ryan, for taking the time to explain those items to inform us a little bit more about what's going on out there. And if anyone has any questions, please get a hold of Ryan. Or, of course, for more tips and information on buying a house, buying a home in the future, go to homebuyingsecrets.com, and be happy to help you in your home search in any way that we can. Thank you very much.